got you on December 20th, you can go get your lower rate at 5.5 in your scenario here, but you're paying whatever the discount point was on December 20th. You were just moving the numbers is all. Where we're like, hey, the market's improved. Here's the benefit to you.
And again, to clarify with them, not to speak out of turn, but it's basically one free time. And I say basically. It's one free time. Now, if the market goes, like, say you went from from your scenario, right? So correct me if I'm wrong, but they were at let's just say even 7%, right? And then it's like, hey, we got, the market improved and now you're at a 7 or 6.25. You're like, awesome. You can float them down. Now, let's say a week later from that, it drops down to 5.7. You know what I mean? They're going to have to pay the difference, correct, to do that because that's no longer a free? Or are you guys able to still move that bar?
So typically it could go that route. It's going to depend. Honestly, just because of the way the market's been, we haven't had that scenario recently. We're having now where you're getting a benefit, but you're not going to see enough of a gain that quickly. Enough improvement in the market that quickly. But who knows? Over these coming weeks and months, when the rates do take leaps again, that scenario could come up. You will have more of a benefit where you can still get to that rate. Yes. Yes.
Okay. And and to be fair, guys, I don't know about you, but I'm starting to have some people come out of the woodworks of people that were looking 2 months ago, 3 months ago.
Absolutely.
That were just kind of like didn't really want to do anything, but like now there's a little bit more buzz.
Yep.
And I it's really we say it all the time. It's not a sell point, man. But at this point, like if you want a better opportunity to get into a home, again, it's probably something I've been telling everybody if you can maybe squeeze it in before the first quarter. It's probably a little bit more ideal because, and again, once the media posts that the Feds are cutting the rates, not only is that going to cause a big spike in the interest of clients wanting to buy homes, but it is going to impact us, positively.
Yep.
And when that happens, that's when you're going to start seeing more buyers coming back into the market. And then it'll be a trickle-down effect. So I don't think it's going to be one of those things where it's like, hey, night and day, like, hey, all of a sudden here comes the buyers. But I think it's going to be a nice gradual change.
I was about to say, I don't think it's going to be like the overnight thing like it was back in 21, 21, right? I guess beginning of it.
Yeah.
I don't think it's going to be just the gas pedal mash the floor. No. I don't really see that. But I do see, at least in this, everybody who's listening, this is literally, we're talking about our market area, right?
Yeah.
So I'm not talking about Chicago. I'm not talking about I'm literally talking about basically Tennessee as a whole.
Yeah.
And I'm even kind of loosely saying that just because Tennessee as a whole has been getting a lot of people in all over the state.
Yes.
Yep.
Matter of fact, I met somebody last Saturday. I went to go look at a property and had somebody just randomly drive up after I got done looking at a property. They're from Chicago and they're here to look at 6 different houses all across the state.
Yeah.
Like,
Yeah.
so it's there are people coming. So again, this is a disclaimer, if you will. It's not about everywhere on the planet this is happening, but for us in our market here, it's going to be. I think going back to that is there's going to be, let's say it's 3/4 throttle, or I'd say 1/4 throttle to 1/3 throttle, and I think it's going to stay there.
Yeah.
If that makes sense. And to put it in retrospect, we're at idle right now, just kind of puttering down the road with our foot off the brake. I think what's going to happen is come probably the second week, if not maybe the first week of February, second week of January, first week of February, I think it'll be about a 1/3 throttle, and it's just going to kind of stay there for a while.
Yeah.
I don't know if it'll really go to like half throttle, but I think we're going to see a constant flow of just about a third of a pickup, if you will. You know what I mean?
Yeah.
Of it. I mean, does that seem
No,
reasonable?
I think that's fair, and I think one of the things that's going to be interesting to me this next 45 days is a sweet spot for a lot of people. You're not. The clients that are waiting on their tax returns won't be able to file those till February, right? So that's going to lean into what you're talking about. So if you have your funds now, you still have sellers that are going to be sitting in a little bit of more of a dead period. This has always historically been the slowest time.
Yeah, exactly. I was like, it's never dead, but it's never like out of control booming.
I said that loosely.
You know?
Yeah, for sure. Clarify, because that is
I was like, it's definitely never dead, but I was
Yeah.
like, things definitely move because you got to understand everybody's mindset's usually about, and I said it earlier, a couple months ago. I was like, usually about the third week into November, so about a week before Thanksgiving, everybody just kind of changes gears.
Yeah.
and then go into holiday mode. So now they're instead of down payments or inspections, they're looking at presents. They're looking at, I got to fly to here or there. I'm going to go see grandma and grandma. You know, it's that whole mindset.
Well, you know, and I'll be honest. I think past couple of years. I mean, I know they're the kind of golden years everyone's talking about, but the past couple of years, I'll say even in December, it was pretty busy for me.
Yeah.
But I think, and again, I think just the way economy shifted, and this whole year, man, you know, it was funny. The budgets are tight, but everybody, I can't remember what article I was reading, but a lot of people are focusing on their budgets. Like that their New Year resolution is fine tuning their finances. Because it wasn't like health, it wasn't like, hey, let me go to the gym. They're like, if we have to go through this again, you know,
again, the cost of living was so drastic over the last 2 years. Like everybody's having to really kind of change their dynamic of what they're doing.
100%. Oh, my buddy Caleb says Daniel and Mike. Okay, this is my buddy Caleb. He's one of my buddies who, my past clients who, unfortunately, was affected by the tornado. But glad he's tuning in. He was in good spirits. He's a cool dude. Yeah, he's an Alabama fan. The Movers dropped one of his...
Alabama fan, go blue, Caleb. Go blue, baby.
One of the Movers had dropped one of his...
So is that why he's not living in your house right now?
Yeah. You know, I gave him a tent, and I'm like, hey, man, $1,800. But I mean...
You would have a place to stay, but you voted for the wrong team.
So I guess let's talk about, you know, I know you guys are working with some builders. You know, obviously, got some things in the works, but let's talk about this. How are your conversations with the builder? Like, I mean, what are they saying? Anything? Or are they anticipating anything for next year? Has anything changed mindset wise? What do you guys think?
I would say, as a broad stroke or broad statement, I guess across the entire industry right now, I think it's everybody's on that side of the fence is trying to find a way to build affordable housing.
Yeah.
It's not that they're like, oh, I'm going to give $1 million away to buy this house, they have. That's a panic move, if you make sense. If that makes sense. I think they're starting. I say they're starting to come around. They have definitely come around to the fact that we need to find a happy medium.
Yeah.
Of something that we can build that's feasible, that works for the average everyday family, but also is affordable for the average everyday family. Because building these $1 million houses, and I say that jokingly, but seriously, like in all reality, like half these houses have gone up $200,000 or $300,000 in the last couple 4 years.
Yeah.
So what is, we're talking, 2000 before everything went crazy.
So let's say it's like 20, like
say
early
19, 20 time.
Yeah, 18,
so
19,
your average price of the house, I think, I could be a little off. I think it was somewhere around 215, 230-ish.
Yep.
That's
What,
spot
is
on.
that about
That's
right?
pretty spot on. Yeah.
So,
For this area.
and then now,
I don't mean to cut you off, but I was excited to get a $300,000 loan amount. When I first started, I was like, "Whoa!"
my first year, I had a $309,000 buyer, and I was like, "What's up?"
It was good. I was like, "Yeah,"
And I was like, "This is amazing."
I know.
Because that was so far out of the norm.
Yeah.
Because I was so used to doing, 100, 125, maybe 230 was, I think, like the second biggest one. And I don't say that as in like a status thing at all, but I was like, just to put it in perspective for everybody, that nowadays your average price of home, if you take all the areas of Montgomery County, I think you're probably floating around 375.
Yep.
Yeah.
I think it's
I would
probably
say
350. I think.
Yeah, I think that's pretty close.
Yeah.
I mean, exit 1's going to be a little bit lower. Exit 8's going to be kind of middle. Exit 11's going to be more towards that 360. So call it 350 to 375, right? You're in that ballpark. So now we're talking $150,000 increase just by average.
But the wages haven't really changed.
Right. So that hasn't changed. Property taxes have gone up.
Yep.
Your interest rate has gone up because their interest rates are higher now than they were in 2019.
Yep.
Yeah.
Because their average, what was it, about 5%ish?
In 2018, 19, about 5.
Yeah,
About 5, right?
Four to 5, like where we're
5.
hoping to go back to,
Yeah.
where we really should have been during the COVID years. Yeah,
Right.
4 to
So,
5.
and again, to kind of put it in a better understanding of, people were paying. So you bought a house for $600,000 during the high time.
Yep.
You got a 2% to 2.5% interest
Yeah.
rate was probably the average of everybody.
Yeah, sure.
Because about 2.3, I think would say it would be a pretty good solid guesstimation for an
Especially
average
in the
for
beginning,
everybody.
yeah, absolutely.
So for that $600,000 house, you're paying roughly. You're still under three grand
Yeah.
a month. So without putting like exact numbers, because I don't know, but you're definitely under 3 grand. You're probably close to
So
$2,700.
Exact.
Yeah.
So I had a client, $450. They
Okay.
bought 18, $2,200 a month with a 2.9 rate. So
Perfect.
right,
Exactly.
right,
I was
in
like,
line with
dude.
what you're talking about. Yeah.
Yeah, I was
right
like,
in line.
so the rate is such an impactful thing when it comes to buying. Like, it's not, and it's not in any way that an agent is going to be like, oh, just spend 10 more grand. Like, it's not that much. It's not. It is, but it's not. It is on paper. It's 10 grand more, but
Yeah.
when your loan amount, doesn't affect it that much more. When especially when your rate is that low. Now, if your rate's a 6%, right, 7%, 8%, something really up there. That $10,000, I mean, that actually really does start to make a massive
I
difference.
mean, we got to a point where that, we would say about $50 a month,
Yeah.
is what the 10K would be, but when the rates started getting to the 8s, it's about 75 a month.
I was like,
so,
we're
coming
looking at
back down to
$75,
where it's
$80
about
a
$50
month.
a
That's-
month.
So
Yeah.
call it $100 more a month.
Yeah.
Yep.
Like,
For everything. Yeah.
Now it's starting to get kind of like, woo,
Yeah.
Yeah.
man.
It was
My
that.
buddy Dustin said you guys should get. We should give you the Golden Beard Award.
The Golden Beard Award.
Golden beard.
It's not very golden, but thank you.
We can make it golden.
Starting to get a little platinum over here.
But I mean, on a real note, do you guys know? So this is my buddy Dustin. He's in the military. On a real note, do you guys know how the do you all know the process with the VA loan? Homie, Dustin, this is our bread and butter. You can ask any four of us here. We're so close to Fort Campbell, man. That's probably.
Oh, I was like, well, I don't understand.
No. He's just asking if we know. Dude, the VA
Oh, yeah.
loan is
70% of the families we help.
Yeah. It's
Yeah.
literally something that we can. You can throw any question at us. 9 times out of 10, we're gonna get it correct.
The only difference between a VA loan, honestly, like in a nutshell, in a broad stroke, the only difference really is going to be you putting money down versus not putting money down. Because your appraisal really has no like it's not no real value effect on anything.
Yeah.
Your inspections aren't any different.
That's a big
What
myth.
you can buy doesn't really change.
but there's a big myth on that, man. A lot of agents who don't do a lot of VA, man. The VA is just on the bottom of their totem pole.
Agreed.
100%.
I just think it's funny because it's like it's funny because it's one of the most secured loans you can possibly get,
Yeah.
and you'll still run into agents that are like, I don't know, and I'm like,
Yeah.
this is more guaranteed or backed than a conventional loan.
And Dustin, dude,
Probably more
I
simplified
don't know
clientele.
I don't know where
Yeah.
you're stationed at, but if you have any questions, man, give me a shout. If I can help you, guide you, great. If I can lend in that state, great. But don't let.
If he can't lend in that state, you're moving.
Tell him to shift your wood.
You tell
Fort
your
Campbell, Kentucky.
handing officer you'd like to move
Get a
somewhere
hold
else.
of Branch. Let's get you somewhere else. All right.
Yeah,
But-
it's that easy. We know. Yeah.
But yeah, man.
Can I ask a question on that?
Yeah, yeah.
So, Kenneth, y'all are going in the building space next year. You see an offer come over conventional. You see an offer come over VA. Are you guys looking at those offers any different just based on the loan type?
No.
No.
Now, okay, well, now I get, and I hope. Okay, so let's backtrack that. So I'm gonna
Yeah,
get back
please.
off your question.
Yeah.
So during the crazy chaotic times, rates for 2s and 3s, competitive market. Now, does that make a difference? Truth be told, I mean, and it's not like obviously there's no right or wrong answer. It's going to be subjective, but I
So
would
it's
say,
case by case.
yeah. So okay,
Yeah,
so
take
how
that
about
one.
this? Okay, you're a listing agent.
So I'll tell you like this. I don't think it is not the specific loan type that should number one ever be a consideration. That's called what's it called freaking I can't think of the word now. You're being bad. Discriminatory. There you go.
You're being bad.
I was like, so one, right? But there are differences between the loan types only because it boils down to the terms of the loan. So in other words, if I had a conventional loan,
Okay.
or he writes me an offer for a house, it's a conventional loan, and he's able to close in 15 days.
Okay.
Sure.
Okay. Now you give me an offer for a house.
Yep.
And you have to close in 30 days.
Yep.
Because that's what now you might be able to, as a lender,
Yeah.
Yeah.
So Brandon's your lender,
Yeah.
you might be able to get it done in 50, but we put on there 30 days because that's a pretty usual fair
Yeah.
time frame, right?
Right.
And that's, despite inspections and things like that. I'm going to look at that as well. If I sell this now, I don't have to make another interest payment on my construction loan. Or if I sell this now, I don't have to holding costs, right?
Yeah.
Like all
You're
those
looking at
things.
the true net.
Right, exactly. I was like, that will 100% affect the true net, exactly. Now, if the loan types are the same, period, or not loan types, but if everything is the same across the board,
Same purchase
closing
price,
date-
same
yeah,
concessions.
like I mean,
same-
honestly, at that point, that's a really like I would go back to them and be like, hey, highest and best, go. You know what I mean?
Yeah,
I was like,
yeah,
because
yeah.
at that point, there's really
Nothing
me
you
as
can
an
do.
agent to advise or to help my seller through that would be like, dude, the math comes out
Yeah.
the same, like.
Here's what we would see as a disadvantage. So, like Dustin asked about the VA loan, that's our bread and butter. When clients are working with veteran clients are working with loan officers that aren't based in VA communities
Yeah.
and are not accustomed to the nuances of VA loans, they automatically want to push conventional for the most part.
Right.
We've
Oh, yeah.
seen that in
Yeah.
17 years. We've seen that over and over.
Yeah.
And they just do it for simplicity,
Yeah.
right? And so what happens though, and what hinders them, especially as this market gets more competitive again, well, now you're putting 5% down on this mortgage, but you also need aggressive on your offer. You also need to pay your own closing costs, whatever the multi-offer situation may be. Well, now you've limited yourself because now you have to put more money as a down payment versus zero down, so you have less flexibility to get it done.
Yeah.
And so what was interesting is we did see some more VA offers win on the educated listing side agents representing the seller because they could look at that whole picture and they could
Yeah.
go, okay, this deal's going to hold together better because this buyer has more flexibility
Yep.
or whatever it might
Yeah.
be as well too.
Yeah, and to be fair, and I think a lot of it has to do with, again, who the lender is, in my opinion. I think, but I mean, there's some agents who don't care, which is fine. I've heard plenty of recent agents say, "No, hey man, I had a deal. They were pretty rocket," and I'm like, well, I mean, it's Rocket, we try to tell everybody, even if you don't go with Castle Rock, the better odds, especially in a competitive market, you definitely want to use a local lender, typically.
100%.
To get a deal done, because I mean, at that point, it's almost like secured,
Yeah.
right? And if something screws up, you're held accountable. That agent come kick your door in, be like, "You screwed me over. I'm gonna
I
murder
tell
you."
people all the time. I say, hey, look, I was like, I would rather you use somebody local, whichever it is,
Me, Brandon.
because I can drive there and kick them. I was like,
Also,
but,
me and Brandon.
You can get millions. You can get millions.
all jokes aside, it's because I want, like, I've got a deal right now that, dude, we can't get a hold of these people. They're holding. We're on our second possession extension right now because the lender just can't get their life together. And I'm like, what is going on? You know what I mean? But they're
And
not.
what
they're-
kind of concern does that build for the seller at that point?
But that's
And
that's
they want to hold on to your client's offer, but
and
they
that's
wanna
what
move on.
and
Yeah.
so for as a listing agent, that's what's like. I'm trying to hold this deal together.
Right.
I know the other agent on their side very well. She's very competent.
Yeah.
Her buyers are very serious. Like it's
Yeah.
it's nobody on the operator level.
It's all clearly an
Yeah,
issue.
I was like,
as a
we
homeowner.
none of us can action on anything, and
Yeah.
it's just like we're just sitting here like I don't understand the problem.
Yeah.
You know what I mean?
Yeah. So going back to what do we have? About 800 to 1,000 homes on the market right now.
Call it 1,000.
Call it 1,000
Yeah.
right now. So still under what we need nationwide. We're talking about nationwide stats and building.
So nationwide, well, yeah.
Well-
so we need closer to probably I don't know what 1,300 probably.
Well, so you know what?
Honestly, to
Yeah.
make it healthy.
So, and I don't mean to cut you off. Okay. So I was on making a TikTok, and then I came across this other lender. I think he's based in Arizona. And,
What a loser.
and he made the comment because obviously he's talking about the supply and demand. Obviously simple, very simple logic. Okay. A lot of people, and I think this is where the education part comes in, because no matter what you say, no matter what I say, what you say, what you say, we're still all classified. We're going to be looked at as a sales. Like they're going to say anything to get you to a home.
Yeah,
And and unfortunately, those are going to be the people that are going to miss.
Yeah.
And it's not obviously. You know what? And if the rates were going to continue to climb, there would be no push of like, oh, hey, it's a perfect time to buy, or hey, you should get it now. We were like, hey, look, rates are getting up. I mean, if you do want to get into a home before the market goes upward to get a little bit more affordability, sure, you might want to look at buying now. But now we're really just pushing for because again, it's a supply and demand issue, and it's
you're in a sweet spot right now.
A lot of people are like, oh, well, back in 2008, they brought up 2008 again, and I'm like, okay, I'm done beating that dead horse. But they're like, oh, well, hey, guess what? They also dropped the rates in 2008, and look what happened. And I'm like, but homie, you're missing the biggest piece of this whole thing. There was so much supply back then that I mean, it was tough to sell anything. Even with the rates low, they couldn't afford anything.
Let's take Clarksville, for example.
Yeah.
1,800 to 2,000 homes on the market at any given time.
Mm-hmm.
I was a lender in that time. That
Yep.
1,800 to 2,000
When's this?
We have been sitting,
2008.
this was 2008, 2010. We have been sitting in that 800 to 1,000 on the market.
Yep.
But we have significantly larger population now,
Yeah.
too,
Right.
that we didn't have beforehand.
Right.
When they just broke ground on a new plant, that new $3.2 billion plant that's going to bring in more jobs and more people.
Yeah.
So, like,
So
this supply, like look at the housing starts nationwide. So like permit starts are up 4 to 9% year over year. Nationwide construction.
Okay.
So builders are still trying
they're
to
still
build.
doing stuff.
Yeah.
They can't build them as fast pre-COVID. They can't build as fast as then. So it's just going to take time for the inventory to catch up.
Well, and they can't build as fast. So let me break this down too a little bit on their side of the tracks. They can't build them as fast because they can't get enough loans pulled out, construction loans pulled out.
You saw this in 2010 as well.
Literally, I was like, because so if I come in and I develop a giant piece of land, I'm like, hey, I got 200 lots in here. I can't go get a builder's loan for a quarter of my lots.
Yeah.
The banks, because the bank is not lending, the bank has tightened up.
Yep.
Great way to
So I can get 10, I might be able to get 10 lots started to get some pre-solds done, or not pre-solds, but either specs or maybe a pre-sold
Right,
done.
right.
I can get those started so I have something, but I can't pull what I could have pulled, years ago. Now, that's again, it's not a market thing, it's a bank thing on that
Yeah.
side. The market side of it is, yes, just like, and you hit it perfectly, and I say this to people all the time. And I stress this. I'm talking about our little ecosystem of the world of Clarks or of Tennessee,
Literally.
right? Literally, like there's
A bubble.
we have this own little bubble that's got like 7 different little ecosystems in it.
Yeah.
And I mean that for real. Like every exit has its own little niches and its own little things. But we have so many people coming here because there's so many industries, there's so many businesses, everything's growing or being built or being established.
Yep.
Like I still will bet you lunch, I still think that the military buyer is only about 35 to 40%. I still think 60 to 65% is non-military. Because that's what I'm dealing with. I'm not dealing with a lot of my fellow freaking army dudes. I'm not.
Which is your base sphere of influence.
Right,
Yeah.
but I'm
Right,
not
right.
dealing
Yeah.
with those guys. I'm dealing with civilians.
Yep.
Yeah.
And I've been dealing with more civilians than anything for almost 1.5 years, 2 years now.
Yeah.
Interesting.
So
And-
what
and
does that tell you? What does it tell you?
It's just the growth of the area.
Yeah.
And that's what I'm saying.
Yeah.
I was like, and don't freak out about, this, that. I get the rates are high. I get it's unaffordable. I'm not arguing against that
Yeah.
at all.
Yeah.
Yeah.
But I'm also, what I am trying to, we're trying to explain today is it is a sweet spot right now.
It is.
Yeah, and you know what? And I said in my video a couple of weeks ago that you can't gain back the appreciation you lost. The
100%.
longer you wait, you're going to miss out on that appreciation because, my example is like, hey, if you buy a house for $300K now, okay, let's just say by May, the market spiked, meaning interest rates cooled off, crap ton of buyers, competition again. It's just it's everything's tight again, and it's chaotic, right? You know what? Your house, you could easily say, hey, you know what? I bought it in December. I'm going to fish it out here for $330. And guess what's going to happen? You're going to get somebody saying $330, and it's just going to be like, bloop. And guess what? But I mean, that's your appreciation, rather than you are the person paying that extra $30,000 by just waiting because of the competition and the supply issue.
Well, in the overall thing is this, everybody.
Supply
is,
demand.
Yeah, definitely supply and demand.
Literally,
it's called. I'm gonna throw this word out there. It's called investment, right?
Yeah.
You have to understand, and you have to look at buying a home. It's an investment.
Yep.
Are you always going to save money doing it? No. But what I mean by that is, should you be paying? If you know for a fact that you can only afford $2,000 a month, right? That's what and I'm not saying like, oh, if I do my redneck math twice and I just forget to carry the one, I can afford to. No,
Yeah.
I'm saying if you can honestly sit down and just do very simple math, round numbers, and be like, I can 100% afford $2,000 a month, and that would make me comfortable. I can comfortably afford that. That's your budget. So first and foremost, I don't care what anybody freaking tells you. You need to figure out what your budget is.
Yep.
If you can figure out what that budget is, we can start talking about price points, and then we can start talking about areas, because a $350,000 house in Exit 1 is not the same as a $350,000 house in Exit 11. Yes, the purchase price is the same. Taxes are different. Is there an HOA? There's all these other things that kind of go into that, right? So we need to kind of figure that piece out. The second half of that is this. If you can't afford that, all right, and I'm going to probably make some people very angry with this, but
Oh Lord.
the 2-to-1, the 3-to-1 buy downs, if that's the only way you're trying to get into a home right now, I don't really think, I think we need to relook at what's going on. Because here's the fact, right? And I run into people all the time that that it's not registering. Your payment will change in a year. The entire concept of this is that you're going to get a 3% interest rate for the first year, right? So that means instead of going from, say we're going to get a 7% is what you're technically locked in at. And let's say that payment's going to cost you, again, fake numbers. It's $3,000 a month is what your mortgage is. Well, let's say that 3%, at 3%, it's only $1,700 a month. I don't know, right? So you're going to pay $1,700 a month for the first 12 months you own this house.
Yep.
On that 13th month, homie, it's going to $3,000.
No, it goes.
Or sorry,
It'll go up
increasing.
just.
Yeah, yeah.
It's going to go up. It's going to probably go up about $300-400.
Yeah.
2,300.
Sorry, yes, but it's going to start stepping up. So what I'm getting at is this: if you can barely afford, or you can't really afford anything above the $2,000, right? Because that was our base number. Then going that route's not a great idea. Now, the pitch for a lot of people right now is, well, if you do this, you can refinance later. That's called gambling. Okay, and I say this because can you guarantee the rates are gonna go down? Can you guarantee that you can refinance?
Yep.
Yeah.
And how fast will they go down as well?
Yeah.
Too. This is a big thing we talk about with our borrowers is, okay, here's, your win for the first 3 years. One of the nice things about the lending world nowadays, since 08, is they do, and they did this with adjustable rate mortgages as well too. You have to qualify off of that higher payment. At the end of the day, it's your qualifying payment. So that is a benefit on paper here, but that's still maybe different than the family budget and what you know deep down, in and out. And so you have that, but we talk about the refinance. That is the goal, is to have that ability to refinance. But we have seen how volatile these rates have been through this window. That refinance could be 12 months, could be 18, could be 36 months. Like, when it refinances, we shall see.
Right.
But it's got to hit a certain point to make sense. Usually at least 0.5% to 1% better than whatever that 7% rate is or whatever, right?
And
when are those
agreed.
numbers going to come together?
I don't like advocating for it necessarily. Like, if that's what they want to do, I've had
Like
plenty-
it's a guarantee. I
Yeah,
don't like when people
I've had
guarantee.
go ahead.
And I totally understand what you're saying, but I think it goes back to the principle that we all preach about, and that is education.
Yeah.
If we can paint the picture thoroughly for the buyers to where they
Yeah.
understand that this is what you're gonna get, and this is how it's gonna be, then I'm fine with that, and they can accept that.
Yeah,
But
it's
if they're
their
under the
decision.
wrong interpretation, then no, I think it's our job
Yeah,
to
yeah, 'cause
step
I mean,
in and
I tell a lot of people, I tell a lot of my agents, it takes a certain buyer to tackle on a temporary buy down. Because at the end of the day, it's one of those things like, okay, hey, your payment at your original rate, are you okay with it? Like, not saying, I can swing it, or not, but hey, are you good with it? Can you afford it? Because at this point, now your 3-2-1 buy down, your 2-1 buy down is just icing on the cake. Because now you know, like, you're gonna be saving money, for the first few years until you hit that original rate. And then if you can refinance, great. If not, you're still going to be okay with that comfortable rate.
Right.
And that's what I tell everybody. So, like, that's why I don't really pitch a lot of it. Because it does take a certain buyer. Because when you blast it on social media, and you don't give a lot of ins and outs of it, it's very misleading. Because a lot of agents are like, oh, you can get this house for 3% for the first year. And to a buyer, like, why not? Like, my payments are going to be great. And then, it does kind of fall under that 2008 of like an ARM, where like it wasn't explained very well. It sounded good. It looked good on paper. Here you go.
Yeah.
And then when the time shifted and your rate changed, you're like, oh snap, you know,
And
this is huge.
And that's my biggest caution. And if you guys haven't figured this out by now, like education is our,
Yeah.
I mean, that's our bread and butter. That's our thing. And it's not because we all desire to be freaking professors of real estate and mortgages. That's not really what it is. It's just
Dr. Mortgage.
Doctor.
Got my doctorate.
Awesome. But our whole I don't like going through transactions. So there's something I always tell all my buyers, all my sellers. When I get done and we're going through either the buyer's portion of it or the listing agreement portion of it, I tell people there's 3 words that I'm not going to hear after this conversation. And they're like, "What's that?" And it's "but I thought." I don't want to hear this.
Yeah.
Because I want to make sure you understand what's going on. I want to make sure you understand the process of what's going on. Right. And it's not because I'm not willing to repeat myself. It's not because I'm not willing to have this conversation. That's not what it is. I want to make sure you actually understand.
Yeah.
Too many people just nod their head and then they stop paying attention.
Yeah.
I know that contracts are not exciting to anybody but me. Like, I like contracts. I know that nobody else in this industry likes contracts. So I understand they're dry. I understand it's hard to understand. I understand that when they get a net sheet from you guys or their actual physical loan disclosure,
Yeah.
you got section A through H or G,
Yeah.
whatever,
Yeah.
right? And they're like, I don't know what any of these numbers are. I can't do 3rd grade math, so I definitely can't do this math, right?
Yeah.
So, and it's, but again, they have to be able to take that time and be like, look, I need you to actually, if you got a question, tell me. Ask me you got a question.
Yeah.
Please.
My job is to break this down for you because, again, I don't want to get 3 days out from closing and then be like, wait a minute, I thought, and you're like,
Yeah.
you know what I mean? It's like, because it's like, dude, like, where did you get off the train?
Yeah.
Right.
You know what I mean? I was like, what point did you get off this train?
But I also think transparency is super key. You know,
Yeah.
that's
Absolutely.
why you know up front. And, you know, me and Brandon, we talk about it all the time. You know, competition's tight, man. Competition's super tight. And there's a lot of lenders, man, that'll tell you anything just to get you switched over. You know, and it's the wildest thing, man, because at the end of the day, you know, unless it's just something like, I mean, I've lost plenty of deals. You've lost plenty of deals where it's like, dude, I can't compete. Unfortunately, I can't compete. Like, not today. Maybe market improves or whatever. Maybe we can revisit it. But right now, I just can't compete. They got me beat, right? But you also run into a lot of lenders where they don't disclose certain fees up front. And the biggest thing I see is like, you know, again, saying your homeowner's insurance is $30 a month.
That's one.
Okay, that's going to mess up your prepays, which plays into your closing cost.
And you're paying it.
And you're paying it. Same thing with your taxes. You know, taxes are going to say, oh, hey, you know, it's $100 on a $400,000 home.
So
$9.99 annually.
So
that's construction.
that's
Yeah.
my biggest two. That is my so.
I just thought all
That's why I was like, I held up my 2 fingers right here, and I heard 1 and I heard 2, because dude, I lose it, man. So I had an agent come into my office the other day with one of her agents, and she's like, "Can you look at this and help me with this?" And so it's not their full disclosure; it's just the net sheet they
like
have.
a fee
Your fee worksheet. And I'm looking at it, I'm like, well, I can't really tell you where a lot of these numbers come from because I don't know what's driving them, right? Like,
Yeah.
I don't, they're like, what do you mean? I was like, well, there's the whole loan, like, there's a
lot of
17
numbers.
pages that go with this.
Yeah.
And I was like, but I can tell you right now, I'm looking at 3 things that don't make any sense to me.
Yeah.
And 2 of them were the insurance and the the freaking taxes, because the taxes were like $150, and it's a brand new construction at like $750,000.
Yeah.
And I was like,
ahead.
"Where's this house at?" And they tell me where the house at. I was like, "Yeah, that's not no $150." and I was like, "And then what about the other one?" And so we're looking at the other thing. For the home insurance was like $100, or was it like $100 or something like that?
Right.
And I was like, "That's probably not right either."
Yeah.
And I was like, and the reason why, so I'm doing quick math with them. I was like, look, everything is times 12, right?
Yeah.
I was like, so you got to understand that these right here are placeholder numbers, and I get what the lender's doing. Like they have to put something in there.
Yep.
Now the new construction is going to be funny. I told him, I was like, because you're going to pay this stuff, and it's going to go to an escrow account because everything's paid in the arrears.
Yep.
But what happens if they estimated you at, and I hope they would never do that, but let's say, like, oh, it's $40 a month for your home insurance or whatever, right?
Yep.
Or your taxes,
Yep.
but yet it's $7,000 a year.
Yeah.
Yeah. Now you're buying
And I was like, so you just paid $1,200 or you just paid $2,000 in taxes.
Yeah.
But now you're going to get an IOU from, or you owe me $5,000 more because you underpaid.
Yeah, in January, February, when the lender sends out, whoever you're making your mortgage payments to sends out your updated escrow balance, and yeah, you're $5,000 short. So if it makes it that far, and it could, because that means it would make it through the lender and through title company before closing. So here's what you're typically going to see in your exact scenario. Hey, everything looks good on the front end. My payment's X. Taxes are $1,000 on the $700,000 home, and then the title company, we get the title work back. And the title company says, okay, we're going to estimate these taxes at $8,000 a year because that's probably what it's going to be around.
Yeah.
Boom. Now your closing costs just went up significantly, and your payment just went up significantly.
And that's
so why
where-
put the buyer through that? Now the buyer may want to walk away.
Right.
So
Yep.
it's not a benefit to the buyer to sell.
Yep.
And
that's
so many
why-
other things may happen.
And that's
you know?
why every time him and I have ever really done new construction, like we'll talk about it.
Oh yeah.
And he'll be like, "Hey man, what do you think taxes will be?" And I'll do it's more or less. I'm just doing a CMA.
Yeah.
And I'm not pricing the house.
Yeah.
I'm literally looking at what's sold in the last year or something something that's recorded.
Yeah.
That is a like item.
Yeah.
As newest I can get, and looking at what those taxes are.
Yeah.
Because I can't guarantee what it's going to be.
You know what?
But I can probably be within $100.
But you want to take a
Couple
little bit of
$100.
time to be a lot fairer and a lot
Yeah,
more
Exactly.
So I'll give you a good example. The Oaks. Okay.
Oh,
Oaks
okay.
is a sought after neighborhood. It really is. There's a lot of nice homes out there.
Shout out to
But-
the Oaks.
But I remember I was in competition with another lender, and they were saying, "Hey, taxes are $2,000." I'm like, "You're about to get your feelings hurt real quick," because
Oh,
I just
ain't
closed
no
out 2
$2,000.
deals over there, man. It's damn near every bid of like 4,300, 4,500, and I'm
Yeah,
like,
yeah.
you're short quite a bit." So I was like, if you just understand that your cash flow is now going to go up. And then also your monthly payment's going to go up. So I was like, you have to go with somebody. I was like, wouldn't you rather feel better knowing that, hey, that number is going to gradually go down throughout the process with us because we over-disclose, we overestimate.
Yep.
Rather than, oh, hey, man, I missed your payment by $200. Sorry, it's
Yeah.
$200.
Well, and that's where you and I have been saying this forever together. I tell everybody, I was like, look, we're gonna brief you worst case scenario
Yep.
I can think of.
Yep.
If you ask me what's it gonna take to get into this house, I'm gonna be like, well, legitimately, market trend wise, or wherever we're at, however it's going, I was like, we can probably be somewhere within X.
Yeah.
I need you to be comfortable with Y.
Yeah.
I need you to be comfortable with Y. And then let's go talk to your lender, and then we talk to the lender, whether it's Daniel or Daniel. But we'll have that conversation, and just to be sure that we're good.
Yeah.
Because I don't, and I don't want to say it's like a bait and switch, because I know a lot of people aren't. They're not doing it on purpose. I firmly believe they're not doing it on
Some
purpose.
is just laziness.
Some
are.
Some are.
Usually non-local because they don't have to deal with the
Right, but I was like, I don't think it's malicious. I don't think it's
majority of the time. I'm saying no.
I think it's just what their program does, or they put a.
Yep.
I don't know, but for me, I never want to get, because for us, because most of you guys watching probably don't do this for a living, we get blamed for everything.
Yeah.
Yeah.
And I was like, I don't want to be the guy that's like, well, sucks to suck. But, you know what I mean? I was like, I don't want that. You know what I mean? I was like, I don't want to put all this time and effort and help for you. I want you to get what you want. I want to help you.
Absolutely.
And if we can be honest from the get go,
Yeah.
like I think it's just transparency, right? Everything's on the table. It's like, look, I work for you. I'll do what you want.
Yep.
But we just got to make sure we lock these things in and make sure you fully understand the
Yes.
process and what it's
Yeah.
going to cost you.
Yep.
100%.
I agree. So, well, okay. Well, let's kind of go around the table and let's talk about some nice wins for the year. I think it's a good way to.
Nice wins.
Yeah. So Kenneth, I'm gonna put you on the spot, man.
Man, I mean, is it professional, personal, both?
It can be both. You can do 1-1.
And
you can do
I'll have to say, just establishing some really solid relationships in the industry, just meeting a lot of new people that are just awesome. And I'll have to say, I've grown a lot stronger as a realtor because of it. So I'm very blessed and grateful for that. Just coming over to you, Adam, and being with the Bearded Home Group, that is a huge win on a personal and professional level. So thank you. I've gotten a lot tighter with you guys at Castle Rock. Y'all are my family as well. So that's a huge win. Really, just friendships. Friendships and relationships. Huge win. So, how about you, Mr. Adam?
At Kellen. Rewind 40 seconds.
Totally kidding, man. Love it.
Nah, I love Kellen. He's gonna chime in one day.
I don't know, man. It's been a weird year, man.
Oh, agreed.
It's been a weird year. I'm very happy. Professionally, I've gotten to grow a lot this year. I've kind of started stepping into some different lanes, professionally in this industry. That's kind of opening some different doors for me. That's been pretty exciting. I'm about to be. I actually got to send my application off, but. I'm more than likely going to start teaching core and CE classes. So I went through my last little TREF course I got to go through, and that's going to be a whole new kind of avenue for me. So again, like we said, I said a minute ago, I'm huge on education. We all are. I don't know, man. I'm excited for the future. I'm excited for 2024. We came into this year, and it was just kind of like it was weird. Yeah. And nobody really knew kind of how to maneuver it, and it's just been kind of a weird, awkward year. But I've taken the downtime that I've had, and like I said, I've tried to invest it into my education and for basically just future endeavors. Yeah. I've gotten to, hooking up with this guy. And we've known each other for years. It's just stars aligned, and was able to kind of work some stuff out. Yeah. And it's. Just a lot of doors have opened up this year that we really feel that 2024 is going to be a really good year for us.
Absolutely.
Not just like monetarily, but just overall. Like I think it's going to be a really good, awesome year.
Oh yeah.
So I don't know. I count this whole year has been a big win. It's just been a big educational win.
Absolutely.
Yeah. I think from the business side, I agree, man. It's been a wild year. After coming off the high, it's definitely a switch, but I think it put me in perspective of how this industry can be, and so how I'm able to navigate and still get business. Because I'll say being at Castle Rock and the amount of support and knowledge we have here, it separates us, in my opinion, from companies, man, who just haven't survived. Like it's just like real estate. Mortgage lending, man, it went through the purge of. The stat I wrote out about a month ago is we started out back in 2020 like 150,000 loan officers. 2021, 175. 2022, that dwindled down to like 130, and then this year at the last quarter, we were projected to be below 90,000 nationwide.
Wow. Lenders.
Wow. So understand it's it's a blessing to be in being surrounded by like agents like you guys that kind of stuck it through, and then growing together. I think that was the biggest thing is growing together with agents, trying to figure out how to kind of keep afloat, and make sure we don't lose sight about what our job entails of, and then coming 2024, I think it's going to be a different year. I got engaged this year. So.
Yes, you did. Congratulations.
Hopefully she's watching. If not,
if you're not engaged.
I try to give a shout out.
Shout out, Carmen.
I don't know if I got my brownie.
Screwed that one up.
Yeah.
I'll piggyback off of that. So, being a lender right now, going into next year, if you're renewing your licenses, same with being a real estate agent. I saw this in 2010. A lot of people that came in and figured it out this year, like you guys did, figured out how to continue to grow and expand, and you re-educated like crazy, and that's why you're going to still be around next year. The perk is we're going to have less competition. It's going to be better market share, and this is better for the consumer standpoint as well too. You guys are going to get better quality realtors, better quality lenders, ones that continue to improve their craft, ones that are looking out for the client's best interest at the end of the day. The bulk of the short-term thinkers have weeded themselves out. Because you can't build a sustainable career that way. No. So, one of the wins for us is we survived 2008. as a lender. We went through that transition. We didn't sell off to another branch. We've held our own company for going on 20 years now, through two very tough markets. And so there was a lot of learning curves that came in the 08 time that we got to reapply and stay ahead of the curve as far as staying strong as a company. So that was a win there. Personally, I've got the wife, I've got the 3 kids. We do sports and then craziness all the time. Seeing all of them grow as well too, just kind of like you're talking about. You know, me and my wife personally, even being around a business that's around finance, you still got to get tighter on some things. You know, it's funny. I look at like my grandparents that, you know, had parents or lived through parts of the Great Depression, had to really keep tight incomes, lived on $400 a month as an active duty soldier back in the day. You know, you know, it was crazy back then, right? So they learned how to budget very tight. They had these tough times, and as you're talking about, you're seeing more Americans go into that mode as well. Now it'll be neat to see what goes on these next few years as a country when we are spenders by nature, to see if a lot of that shifts across the backboard. So, you know, what is that clip that went around all year? You know, tough times make tough people. This is toughening up a lot of Americans. I think that's going to be a big win as well too. Never fun to go through any different circumstances, but it's a blast. And then you get to see my kids operate in their sports, whatever they're striving for, and learn tough losses and how to improve and things like that. It's fun to see and appreciate being older, what those tough times do and those little losses do to actually win down the road. So it's going to be, I'm with you. I'm really looking forward to 2024. We're getting a nice little momentum as an industry with the rates going down 0.5% to a point. So it's a nice little springboard into the new year. I will take that. And obviously it's an election year. So we're going to continue to see positivity around these rates moving forward. And that's going to be good. But I agree. This sweet spot of the next 45 days is going to be interesting. If you're on the fence, reach out to this crew here because there's going to be some wins where it's just not, it's the supply and demand like you talked about earlier, right? So the competition level, it's going to be down from buyer to buyer standpoint. And like Adam talked about, once that February timeframe hits, and those tax returns, those people that file early so they get their tax return money quick, they're going to have an opportunity as well too.
Dude, I'm telling you, like I'm telling everybody out there watching, I don't care if you're a lender, a realtor, or just a dude.
Or dudette.
Or dudette. The time now, 5 seconds ago, through pretty much the end of January is your golden hour. That is the time to capitalize. I mean, unless rates go up crazy or something crazy happens, and I'm talking statistically speaking, year over year trends, right? February is going to get hot again, and that's when it's going to get competitive again. It's not a sales pitch, guys. I can't say it enough. It's literally it's yearly trends. It does not change.
And then it's just we're just looking out for your investment. That's it. We want you to invest because our goal is to put you in the best equity position as us lenders, and then as agents they want you to get your biggest bang for buck on return, your ROI, return on investment. And so just understand, guys, all the people who missed out during the golden years. This is kind of your opportunity to kind of squeak in at the tail end of it before.
Golden for nothing.
Oh, listen, golden phone calls, because each time you pick up, hey, bro, I'm looking at a house. I didn't get pre-approved it like 5 minutes ago. I'm in trouble.
But just understand, the 3% rate or whatever, the magical rate, it came at a price. Dude, it came at a price. Anywhere generally between $20,000 and $50,000 is what that costs you.
And again, that's the biggest. That's another thing. We'll kind of end on that. Is you guys have to understand, if you want to wait, that's fine. Again, it comes at a cost. We talk about it. The people who bought back in the 2s and 3s when you had to go and over ask and get your closing costs paid for, you paid for that rate. 100%. I mean, the sacrifice, I'm glad on paper it looks good. Trust me, your monthly payment looks good. Like, I get that. But how much money you had to dish out to get it?
Not finance.
Not alone. And honestly, I encourage that, man. Like, for people who bought back in the 2s and 3s, which I'm glad you're in your home, you got a phenomenal rate. But go back and look, compare the rates now versus what you got, do the difference, and see how much money you actually had to throw into that transaction in order to get that rate. And see how you even came close to recouping that money.
That's what I ask everybody is, how long does it take you to get the money back? Is it worth it?
You're talking about going over asking.
Every time. How many months are you going to live in this home? If the average, so again, not to drag this on for another 2 hours, but it's the average person literally only typically stays in a house for 3 to 5 years.
Yep.
And that does not matter if you're 90 years old or 9 years old. You literally, it's 3 to 5 years is the average term that somebody stays in a house. Now they may own that house and they may go move somewhere else and live in the house, but you only
You're
you're still moving.
Yeah.
So with that being said, if it costs you, $300 more a month, whatever, to get that house and you live in it, or you save $300 a month for the next 3 years, right? So that's $3,600, or sorry,
$3,600 a year.
yeah, $3,600 a year. Sorry. Did you spend more than that?
Yeah.
Or are you gaining that? And again, once that 3 year period expires, you're not at a plus, you're at a zero.
Yeah.
Yep. It's just like
Now that 3 years, you're actually starting at zero. Now you're starting to build your equity because you haven't even paid yourself back yet.
Yeah.
Does that make,
Yeah,
that
no,
make
no,
sense?
100%. Because I mean, think about like if closing costs, let's say we'll ballpark at 300,000. Let's say it's 10 grand. Let's say you opted to do a $10,000 appraisal gap. Okay, it didn't appraise. Okay, cool. Well, you got a 2.5%, but you had 20 grand in this whole transaction, right? Okay, now rates are a little different. Let's just say that house now is let's just say even $400 a month. Okay, you're still not. It's going to take you at least 4.5, 5 years just to recoup that 20. And again, like you said, to break even because of where you could have been with that money.
And understand that, I mean, there's this thing called appreciation that goes to this too. So say the average appreciation is somewhere between, I don't know, 15 and 20 grand per year on every house here. So it's somewhere in that ballpark.
It's about 5%.
Yeah,
The projections are about 5%.
So X11's closer to 3.5, X11's closer to 5%. So yeah.
Yeah.
But
Okay.
but literally,
I agree.
we're talking 15 to 20 grand per year. So you can factor that in. But what I'm getting at is the money you spent ahead of time.
Yeah.
You know what I mean? Like, it's not just appreciation. Like you've got money into this.
Yeah.
Yeah.
So
That's why getting it earlier, let's say these next 45 days, were just because it is something you got to look at if you're really considering buying, because you get in now when you can negotiate and have opportunity. And as a seller, these sellers typically need to get out of the house for a reason. They've PCS'd out, whatever it might be. They're selling for a reason right now. So you get an opportunity, you get a good deal on a house now. The rates continue to drop. The market gets more competitive post-February. That helps your appreciation. That gives you more opportunity to refinance because you need equity to refinance. Because it does have some cost to it.
Yeah, I was like, the money's got to come from somewhere.
It's less than a purchase, but it does have some cost to it. So there's things that you want to be in a good spot to have the ability to take advantage of a refi whenever that may come.
Yeah.
And there is a lot of things to play into it. So I think when you're reaching out to a group like this, you're getting that info. Here's your education pieces. You will at least have all the tools you need to make a decision.
Right.
And then you decide what's best for you and your family.
Right.
If you don't have your family's budget,
My vote
you do
is
everything.
my vote is look, if you can get in for nothing, get in for nothing.
Yep.
Yeah.
Because again, it's not your forever home. You're gonna stay in there for 5 years.
Yeah.
And this is gonna sound really crude and messed up, but if it's got 4 walls of roof and you can poop in it, like it should be a consideration. Like I'm being dead serious.
I know what you mean, though. Yeah.
But I'm being serious because some people are like, I don't know, it doesn't have 20 bathrooms and 15 acres. I'm like, but do you really need all that? And it's not
It's
that
not the perfect Instagram home.
Exactly. I was like,
Yeah.
but does it meet your needs? Does it fulfill what you are requiring from your house? So if you look at it from that aspect, it's like, okay, cool. So what if we could get you a like item that is an 80%, 90% solution, but we can get it to you for you walk in for almost nothing.
Yeah.
Maybe it only costs you $5 grand out of pocket to walk
Yeah.
in versus 25.
Let's take
That's
that
money you
scenario.
never had to burn.
Yeah, let's take that scenario. Let's look at a conventional 3% down on 400,000. That's $12K to get in if you get sellers to cover concessions. What's the first thing that's going to go when the market gets hotter?
Concessions.
Those concessions are going to pull away because somebody's going to say, "Hey, I'll pay my 3% down and my 3% in closing costs."
So
whatever it
so
might
now
be.
you're at what 24K.
So now you're at 24K invested. Your ROI is going to take longer to recoup. To your point earlier, than it would.
Almost a whole nother year at that point.
It's just you just gotta. It's kind of like helping people take the blinders off, man. As a society, and again, the old way of thinking is like you need to have the best rate, which I understand you got to do what's best for you and your family, but it's not everything.
Would you? So, I gotta have the best rate. So, would you rather pay $2,400 or $24,000?
Yeah.
Right.
Or would you rather just pay $300, $400 more?
like
a month?
installment plans.
If it's affordable, if you pay $300, so again, let's go 300 again. So that's $3,600 a year, right? So times that by freaking 4 or 5 years, you still have not gotten to 20 grand.
Yeah.
Well, you're close to it.
Close.
But or you know what I mean? But I was like, but you're not even making, like, you're not on the equity side yet.
Yeah.
You're still on the repaying myself side. Now your appreciation will kind of help overlap that, but your investment you're not getting back, and that's the thing I keep trying to tell people. Like, but you're missing the invested portion that you put into it.
Yeah.
You haven't got it back yet.
Yep.
So if the seller is willing to pay all your stuff, go with that guy.
Yeah. Well, and here's the deal too. You touched on this earlier with the 08 and the housing prices and everything. We just talked about the inventory differences. There is a whole nother brigade coming to Campbell, right? Am I phrasing that the right way, or how would you phrase?
Yes. So I.
Roughly
It's a
1,000
Chinook.
plus?
It's a Chinook.
Yes. So it's from what I understand, yes, it's not a brigade. It should be a battalion.
Battalion. Okay.
That's
I
coming
didn't
in.
want to overstep my lane there, so I wanted to make sure. So significant amount of soldiers that'll be coming into the area. You have this new plan that just broke ground that will also bring over the next few years over 2,000 jobs.
Wait,
within it.
well, is this new plant? What is this one again? Is it
The LG,
LG
battery,
But then
Yes.
also you have Amazon.
and you got Amazon.
You got Amazon.
And you have these plants that are continuing their phases.
Yeah, I was about to
that
say.
are
I was like,
bringing
in
more
every
people,
plant we have
Hankook,
here,
all these other things. Yeah,
they're all in the process of growing right now.
Yeah.
They're all building and expanding.
yeah.
So
They're
that's
on phase 3,
more-
phase whatever. Yeah,
Literally.
which is more. So continued influx into the area. We still have California coming, Chicago coming, Florida's come up this way a little bit. We've got, Colorado's got some new interesting laws that may push people this way as well too. So you've got more stuff. Being honest, you've got more stuff that's going to drive more people into these areas. And Clarksville is still very much a prominently cheaper area.
Dude, we are almost default. I think we're second or third in the state, basically as a catch-all. Does that make sense? Like,
well,
I say
yeah.
that as in, like, because they're only going to either us, Memphis area, or they're going to Chattanooga kind of thing. And when I say us,
Yeah.
it's us and Nashville kind of tackling area.
We're that Middle Tennessee
Yeah.
catch-all. let's
Not
say.
just Clarksville,
So-
but this general area.
You have that. You have no reason for your supply and demand that is going to push the cost down. If it means the costs are going to do what they did this year and hold a lot, continue to rise. Even at the slow peaks, they held at a bare minimum, and then they're going to continue to go up. And as the rates dip, more people are going to come out of the market. They're going to sell their houses, cash out on the equity, because it's easier to go from a 2.9% rate to a 4.5 or a 5. You can stomach that a little better than a 7 or an 8.
Yes.
And so now they're going to finally cash out. They're going to come in, but they're going to buy something else and sell that house. So it's going to rotate out. There's not going to be a massive crazy.
And they're going to have
influx.
enough equity. They're going to have something they can put down or buy a rate down, and so it's going to be an easier flush.
They're,
an
they're
easier
going to
swallow
be competitive. They're going to wipe out maybe a ton of debt as well too. Just having a mortgage. Like there's so many smart ways you can attack that equity and utilize it for your finances.
Yeah.
But yeah, so
I break that down to a lot of people. I'm like, if you were to sell your house and instead of spending an absorbent amount of money on a down payment for this next house, what if you just cleaned out all your debt? And when you sit down and do the math, for a lot of people, believe it or not, if they just cleaned out all their debt, they're actually saving money with a higher interest rate.
significantly there.
I had a couple that were saving almost $1,000 a month just because they wiped out debt and took a almost double interest rate.
Yeah, and imagine what you do. Take that $1,000, put it right back against that mortgage, knock off all that interest you were going to pay on the backside.
Literally.
I mean, you can make a
And
massive
then
gain
you
on
have so
$1,000
you
a
start with
month.
a 30-year mortgage, and then by year 7 you're down to a 15 or almost 12-year mortgage at that point because you dumped that much into
You're
it.
just-
I was like, dude, like, and you explain this to people, and they're like, I never thought about it like that. And it's not
That
because
is
you
the
just
most
don't know.
common response I get.
It's because nobody's ever took the time to be like, let's kind of battle plan this out a little bit.
But-
Let's go through a few different scenarios.
But again, it goes back to the old way of thinking, man. Like too many old. I'm not trying to not call people out, but old
Like jumps.
No. But like the old way of thinking is like, hey, you need to have the best interest rate. Whenever you sell this, all your proceeds go up and go to your new house.
Yeah,
it's like
pour it all into the new property.
but again, it's the education part, and like you said, with credit card debt. I mean, credit card units at an all time high. Auto loans
We've
at
hit new
significantly high.
limits as a nation every month
Yeah.
in this quarter.
Yeah.
Like every
Well-
month it's been a new
We're
all-time
getting
high.
to the max. We went from max savings to those depleted as a nation to now hitting max credit. Credit
That's what I'm
are
saying.
maxed out
Yeah.
too.
I was
So
like,
with
we've hit-
22% interest rates or whatever on them right now, that's 7% on your new house refi or purchase because you can cash out this equity and clear all that other debt. I mean, it can be a massive move as well too. But now it's at 6.5 versus 7.5. So it's the time to have conversations if you've been on the fence for sure.
Absolutely.
So, well, I think that's going to wrap it up. I think next week I think everybody's going to be. Are you gonna be here?
January, y'all will be back in session, I believe, right?
Yeah. So this will be the last podcast, and honestly, we are to continue to grow this. You know, I definitely want to get some mics I can plug into the people tuning in on Facebook Live, because I know it's probably echoey. I don't know where the other ones went. When we placed on the table. But anyway,
I was like, they were here when I left last time.
I'm going to tell James when he has a stocking stuffer. So I'm going to get that. And then, you know, as time goes on, you know, maybe we get a couple of leads out of this too for just coming here and pure education and talking. Yeah, it'd be nice to upgrade the camera and it'd be a little bit more, to give it a little bit better professional look. Even though we're not very professional. Like, this is what you guys get. We're very professional at what we do. But you look at
I
me.
am what I am.
Yeah.
People think I'm a construction worker.
Listen, but y'all are honest.
I was
transparent. You give real advice that's actually going to benefit
Absolutely.
people tuning into this.
Absolutely.
You know, I've been doing this as long as I am. I listen to it as well too because it's fresh perspective.
Yep.
And you guys are just trying to take care of your customers the right way.
Absolutely.
And not see them miss out and not see them get taken advantage of. And, you know, that goes a long way for people.
Oh, yeah.
What if we tried to set up next year something to where it's interactive? Are we able to do something like that?
Let's interact, like
As in they can, besides just
a phone call?
Like a call-in show?
Like a call-in show?
Call-in, I like
Hey,
it.
I like that.
Oh,
Yeah.
God.
Oh gosh. Dude, we're gonna get some
It can go
Hey,
good or bad.
I think it'd be kind of, and anybody who's watching here, anybody who continuously watches, if you guys ever want to just show up and either sit at the table or sit on the side, we're pretty set with Wednesdays at 1:00 at Cass Rock Mortgage.
Yep.
I mean, you are more than welcome to come in and hang out. And if you're another lender, if you're another real estate agent and just want to kind of come in and have a conversation, I would love that.
Well, yeah, you know, so like I've invited Carla Baker. You
Yeah.
know, me and her are actually doing one after Christmas, so she'll be coming in. I'll be sitting in with her, getting a few different perspectives, see how
I'm gonna
you know,
kill her.
I'm gonna see how she's doing. Same with like Britt and her team. Kelly and her team. So Britt, Kelly, Sarah, and you know, I've reached out a few others, man, because it's nice to get a good perspective. You know, obviously this is our slot. Nothing overtakes our slot.
People will disappear.
I got hearts on my calendar that says podcast with Adam. Heart, you know.
But 100% real. Like I love having the adult conversation, the intellectual conversation. I love it,
Yeah.
and I love hearing different agents,
Different perspectives.
literally, and their different
Absolutely.
engagements of how they kind of attack different
Yeah,
problems.
it's how we
I
learn and
love-
grow.
Yeah,
you know?
I love it. I love it. It helps me so much to understand different things.
Yeah.
Yeah, agreed.
No, honestly, I'll ask James because you can get like a phony, like a burn number, like with Google.
To call in.
To call in,
and
yeah,
talk.
to call in, you give them a little thing to call, and I like that idea.
Yeah, I think it'd be kind of cool.
If anybody has tech experience with that, please reach out to Dave. We need to shorten that learning curve as fast as possible.
If
That's
anybody
gonna
wants
be
it, if
interesting.
anybody in college wants an internship here to get to the
Do not reach out to me. I will show you how to make smoke signals.
All right, so I guess that's it, and we'll see you guys next year.
Merry
All right.
Christmas, Happy Holidays.
Later.